Hi there, welcome to Kneppy Invest. Time for another technical update looking at the charts for six ASX companies. Interesting choice today. No rhyme or reason behind the choices of companies I want to look at today. But when you do look at the quality of the companies, the six companies, there is a wide range. So I will be looking at two of the best quality companies on the ASX and probably the worst quality company I'll be looking at in this video. Well, better not say anything bad about any companies. Just you'll be able to see the quality of that company when you look at the chart over the past 2 years. It's a recent IPO. When I say recent, I'm talking about 2 years ago. And at one point in time, this company was highly thought of, not anymore. So let's have a look at the six companies I'll be featuring in today's video. The six companies I'll be looking at include those two really high quality companies, which are CSL and technologyone. You could argue that Ramsay Healthcare is a high quality company, but I'd probably argue or counter argue against that. Magellan, at one point in time, a few years ago, was considered a high quality company, probably not anymore. And then Bega, the great Australian food company. That company is actually looking interesting. Share price is now at about, I think, a 9-year low. And even though I wouldn't call it Bega a high quality company, I think it's quality enough that it is interesting right now. And that really bad quality company, well, I shouldn't say bad quality company, but that disappointing company is Nuix. They've released another trading update, and the market reaction in regards to that trading update just makes me want to look or have another look at that company. It's not have a look in regards to wanting to buy that company. It's just the share price has decreased so much from when that company IPO'd 2 years ago. Not even 2 years ago, 18 months ago. First company I want to look at is CSL, one of the highest quality companies on the ASX. And if you do want to hold this company right now, you will have to pay a little bit of a premium. And really, that premium has been there for quite a few years. Now, I'm going to show you two charts here. And for most of the companies in today's video, I'm going to show two charts. The first chart here is the weekly chart going all the way back to 2011. If you go all the way back to 2011, share price of CSL was around $30 range. So if you were in the stock market at that point in time, and I did hold CSL for a little bit of time. In fact, when the share price doubled from about $35 or $40 to about $80, I sold out. I thought I was a genius. Share price kept on rising. So I did learn my lesson. And probably CSL is one of those companies where you could hold for the long term. And I think you'll probably do okay over the next 5 to 10 years. You might not do spectacularly well, but you will do okay. So really from about 2011, early 2012, all the way through to the end of 2019, the share price of CSL was in a well-defined uptrend. In fact, that uptrend accelerated from about 2018 into 2019. But the share price of CSL actually did reach a high just before COVID-19, and that high was about $340. But since that high and since COVID-19, the share price has been going sideways, trading in a range, and that range is between about $250 and $320. So when the share price gets towards $250, that's the time to buy. And also when it gets to about $250, there actually is some value when it comes to CSL. And when I say value, I'm not talking about comparing CSL to other ASX companies. I'm saying when you compare CSL to historical valuation numbers, when share price gets to about $200.50, there is some good value. So it's attractive based off historical valuation metrics for CSL, not for other companies. And when the share price gets to $320, it's a little bit overvalued. So I probably would say CSL over the next, say, 5 to 10 years, I'd say the base case would be growth of about 10% in the business. With a PE ratio of about 40, I wouldn't expect any multiple expansion over the next 5 to 10 years. So PE ratio more than likely will actually come down a little bit. So I think the best case scenario is about a 10% return when you're talking about capital gains. But when you do include dividends, and I have no doubt dividends will improve or increase over the next 5 to 10 years. And when you do increase include dividends in your overall return for CSL over the next 5 or 10 years, I think right now can or could be an attractive buy. But the market, I think, has thought likewise because we have seen a bit of a run in the share price of CSL over the past month. So let's have a look at the daily chart for CSL, and we have that top of the range around about 320, and the bottom of the range is actually around about $242. And this is the yearly chart. We have seen share price reach the top of the range, and that was reached in November last year. It didn't take long for the share price to go from the top of the range to the bottom of the range because the bottom of the range was reached in February, and now we have seen the share price wanting to move up towards the top of the range. And in fact, the share price has increased a fair bit over the past few months. In fact, it's moved from $255 to $300. Soon as the share price hit $300, we did see a little bit of selling. So again, round numbers are very important, very significant psychological level for traders. So if you don't believe psychology is very important when it comes to buying and selling shares, all you have to do is look at where share price tends to hit resistance and support levels. And a lot of resistance and support levels are at round numbers. And $300, I think, is a very important psychological level for CSL. I think even more important psychological level is about $320, which is above the top of the trading range it finds itself in. And I think the next step then will be $350. Eventually, over the next few years, I think CSL will get to those prices. I think that the upside from here is a little bit more certain than any sort of downside. So that's one of the reasons I am attracted to CSL. The other thing is I would say CSL will be facing potentially some really good tailwinds behind their business, their plasma collection business in the United States, particularly if the United States goes into recession and people are financially strapped for money. They might want to go to CSL Clinic and get some plasma taking out to get a payment. So I'm wondering whether a sort of a recession-like economy could be beneficial for CSL. Next company I want to look at is Bega, the great Australian food company. And I became a little bit more interested in this company when they bought Vegemite a few years ago. So just like CSL, I'm going to go look at the weekly chart first. And this weekly chart goes all the way back to 2013. The reason I want to go that far back with Bega is because the share price right now is at a 9-year low, and the share price is about $3.20. Last time we saw the share price that low was way back in August of 2013. So the share price is moving down, and even though the share price is in a downtrend, I think right now the valuation of Bega is becoming more attractive, where I think the upside is more likely than any downside from here. Unfortunately, Bega Cheese did release a trading update on the 13th of July. They released it at 7:27 p.m. And whenever I see any sort of trading update, any sort of financial numbers released late like that, it does make me nervous, because why would you not release it just before opening if it's positive? So I don't know if there's any research done on this, but I probably would say that any sort of announcement like a trading update released really late is saying that there is a good chance that trading update is going to be negative. It was negative in regards to how the market looked at it. Share price did sell off by 8%, and that's why the share price has moved below a nice little support level at about $3.55. So that trading update, I did have a quick look at it. Nothing absolutely horrible in there. They looks like they are going to hit their guidance. They also released some guidance for next year and no growth in the company over the next year. So that's one of the reasons why the share price has been selling, is the lack of growth this company is expecting over the next 18 months. And one of the reasons I am also interested in Bega right now as possibly a short-term trade is we have seen share price pull back a fair bit over the past few months. Share price falling from about $5 all the way to a current share price around about $3.30. So I wouldn't be surprised to see a little bit of a bounce here. And a lot of times when you do see share price decreasing like this or increasing like this, a fairly sharp increase or decrease, typically there is going to be a bounce. If there is no bounce, that would be actually a very bearish sign, and that would be telling us no one in the market is liking where Bega is trading right now. So I would expect a bounce, particularly if the market is seeing value in Bega right now. I am seeing possible value. And when I did look at some of the valuations for Bega, it is looking cheap. Now, just because it is looking cheap doesn't mean it's a good buy. It could be looking cheap for a reason. And one of the reasons could be the market is not expecting much growth in the future. In fact, they could be expecting Bega to go backwards in the future. And if it does go backwards in the future, then Bega right now is not cheap. So a lot of things to look for when you're looking at this company. And this is one of the reasons why you might want to just wait until there's a change in shift in sentiment or a change in the trend in the share price, or we get confirmation that the company is growing, but you might have to wait a fair while. And if you do wait for that confirmation, the share price actually might be significantly higher and might have already moved into an uptrend, or there could be already a change in sentiment. So one of the reasons I do like to look at the chart is to just look for that change in sentiment. And a lot of times, well, not a lot of times, I will say the market is smarter than me, and it will see well before Bega releases any positive news. The market will see that potential, and that's when the share price of Bega will start going up, in my opinion. So you could just wait for that, wait for that signal, wait for that confirmation in the chart, wait for that shift in sentiment, wait for a change in the trend in the share price, because the share price could go significantly lower from here, even though I am thinking there might be some good value in this company at these current prices. Next company I will look at is technologyone, another really high quality company on the ASX. And just like CSL, if you want to own this company in your portfolio or buy it right now, you will have to pay PE ratio, I'd say it's closer to 50 than 40. And when you compare the growth of this company to the PE ratio or the PE, any sort of ratio, you will probably win any sort of argument in regards to this company being expensive. But again, because it is such a high quality company, you do have to pay a premium, and that premium is in those valuation metrics. So this is the weekly chart for technologyone going all the way back to 2008. You can just see why a lot of professionals, a lot of those experts say when you find a really good quality company, just buy it and hold it for as long as possible. Because if we go back all the way to 2009, 2010, the share price of this company was about 50 cents, or sort of in between 50 cents and $1. Current share price is about $11.50. So this has been a 10-bagger over the past 11 years. Share price is still in a nice little uptrend, and that uptrend really started in 2018 when the share price fell to around about $4. So even if you waited for the share price of this company to slip back like it did in 2018, and remember, the market did have a bit of a hissy fit in the last half or last 4 quarters or 4 months of 2018, because the market was expecting the Fed to raise interest rates. So again, the market hates rising interest rates, particularly in tech companies. That's why we saw the share price of technologyone fall back then, but it's been rising ever since then. I have been waiting for a significant pullback in the share price. And that significant pullback in the share price is to around $9, $9.50 now. And every single time the share price of this company gets below about $10, you have to look at that in the daily chart. So actually, let's have a look at the daily chart now. So every single time the share price, and it's only been 3 times, the share price has got below $10. I've been waiting for it to get to about $9.50 or hit that uptrend before I took a position. But every single time the share price gets below $10, we do see some buying coming in. So the market is aware that this is a high quality company and they have to pay a premium. And the market does get excited when the share price falls below $10. So if you do want to hold this company in your portfolio, you will have to pay a premium. The other interesting thing, and this is just a short-term shift in sentiment and trend in the share price of technologyone, does look like it is wanting to move higher. Share price tested the previous high we did see back at the start of the year at about $11.70, and the share price wanted to get above that, but has fallen back today. So if the share price gets above about $11.70 on strength, I think that could be a buy position, because if it does get above that, that would mean the share price is at least a 7 to 8 month high. And that is one of the things I do look for these kind of trades. Next company I want to look at is Ramsay Healthcare. And there was a period of time back in the 2010s where Ramsay Healthcare was a wonderful company to have in your portfolio. I did own this company for a while because the share price increased from $6 back towards 2009, 2010, all the way to a high of $84 in 2016. So over about a 7-year period, this company was, what's that, a 14 bagger? So that's the sort of returns you want over that sort of time frame. Unfortunately for shareholders, since the share price did reach that high of $84 in 2016, share price has been going sideways, just like the company itself. We did see the share price reach $84 recently, and I'll talk about that or the reasons behind that in the next slide. But at this point in time, share price is going sideways. I'm waiting for any signs of return to growth in the business or return to an uptrend in the share price. And really, I haven't seen that over the past 3 to 4 years in this company. As we turn our attention to Ramsay Healthcare's daily chart, this goes back to March 2021. You'll see between March 2021 and April 2022, share price is just going sideways. No reason to be holding this company in your portfolio, particularly if you are a momentum trader, because there is no momentum at all with Ramsay Healthcare during that period. And it just follows the lack of growth in the business overall. And then on the 20th of April, Ramsay Healthcare did receive a takeover offer. That's why we saw a massive jump in the share price from about $64 to about $80. But you'll notice the share price has been drifting ever lower since that takeover offer. I had a look at the announcements, and the company has not released any sort of announcements suggesting that this takeover offer is in trouble, anything like that. But I think the market is expecting this takeover offer is in trouble because I think the takeover offer was for 85, 86 or 80, something in the $80 range or high $80 range. So if you bought right now at about $70, there is a bit of an arbitrage there if this takeover goes through, a fairly large one. So I think the market is expecting this takeover offer not to go through at this point in time. A few years ago, someone said, a colleague said, this was the only company, individual company they owned in their portfolio. All the other companies they owned, or not companies, all the other investments they had on the equity market were in regards to ETFs, and they believed this was a very high quality company. And you can see the share price. This is the weekly chart going back to 2014. You can see the share price during 2019 just simply exploded. Share price actually grew from $24 at the start of 2019 all the way to a high of $74 just before COVID-19. So a lot of positive vibes in regards to Magellan Financial Group back in 2019. Those positive vibes have really come back because the share price has fallen from $74 all the way back to $12. And if we retrace the last time, or look at the last time the share price of Magellan was this low, was way back in 2014, around about August 2014. So you can just see how long it took for the share price of this company to get from $12 to the high of $74. So 2014 to 2020, it's only taken 2 years for the company to fall back to $12. So again, fear is a much more powerful emotive motion than greed. And that's why falls in the market happen much quicker than rises, not only in the market, but also individual companies. Rises happen much slower than falls. So right now, it could be interesting for Magellan, but they did release their funds under management recently, and it was another significant drop in funds under management, and we did see the market react to that. So let's have a look at the daily chart for Magellan just to see if there's any signs of a shift in trend and a shift in sentiment. As we now focus on Magellan Financial Group's daily chart going all the way back to October 2020, the reason I want to go that far back is even though the share price actually did reach a high of $74 just prior to the COVID-19 financial panic, share price actually did rebound back up to $64 in October of 2020. And ever since then, the share price has been dropping. Now, back in June, July of last year, did look like possibly the trend was trying to shift. You can see the share price actually starting to rise. In actual fact, it bounced from $42 back to $56. So I thought maybe there was a shift in sentiment at that point in time. But when the company did release their full-year results in August, there was a big down day, and that was a catalyst behind the re-rating in the share price. That was the shift in sentiment. That was an automatic sell on that day. And the share price finished on that day at $46. The share price has fallen from $46 to $12 right now. There's no end in sight to the decreasing share price, but you could argue the share price has stayed above about $11.75 over the past month and a half. So maybe it has found a bottom. Probably just say maybe. I would like some confirmation that the bottom has been reached, and we have no confirmation right now. Share price is in a well-defined downtrend, and there's no reason to suggest the share price can't fall any further from here. Last company I want to talk about is Nuix. This is not a great quality company. This is not a good quality company. This is not even an average quality company. Yes, Nuix is an example, a great example of a bad quality company on the ASX. Doesn't mean it'll always be bad quality, but right now it is a bad quality company. And it has been an absolute horror story for any shareholders who bought into the IPO or who bought into the hype around this company in late 2020 or early 2021. So I'm talking about January 2021 and most of February 2021. Share price reached a high of $12. And then in late February 2021, the company released some bad news. So more than likely that was financial results. Share price fell 33% from $9 to $6. And I know there were some people out there who saw the share price at $6 on that day and thought this company is great value. A few months ago, share price was $12. Now it's $6. It's so good value. That was, in my opinion, that was not a buying opportunity. That was a warning signal. And that was a catalyst for the re-rating in the share price. That was a shift in the sentiment of this company. And the share price has been dropping ever since then. And the company just keeps on releasing bad news. On the 18th of July, the company released their financial year 22 results update. I have not read this update just yet, but I know it's not good because when the company released this update, share price fell 13%. So that was on the 18th of July. I'm recording this video late on the 19th of July, so about 7 p.m. Share price has fallen another 5.5% on the 19th of July and finished today at 60 cents. So just remember, there were people who thought this company was great value at $6. It is now 60 cents. So whenever you see some bad news released by a company, be aware. That could be the shift in sentiment of the company. There could be more bad news to come. It's not necessarily a buying opportunity. What you do have to wait for is a shift back to positive in the sentiment and a shift in the trend of the share price. We have not seen that with Nuix since we saw that negative announcement back in February 2021. So now let's have a closer look at the daily chart for Nuix, looking at the past year for the company to see if there is a change in sentiment, if there is a change in the trend of the share price. And of course, you know the answer to this. Nuix share price is in a well-defined downtrend. This is the daily or the 1 year daily chart. Did look like 1 year ago between July and towards November, December, the share price was maybe trying to consolidate. It was going sideways. But then as we moved into December, late November, early December, share price started to drop again. And then, of course, on the 18th of July, they released that financial year 22 results update announcement. Share price has dropped significantly more from that announcement, and there's no end in sight to the drop in Nuix's share price. So with this company, what I would want to do is to see if this company is turning around their financial performance. If they do start to turn around the business, you might start to see the share price climbing and moving into an uptrend, and that would coincide with the shift in sentiment of this company. But at this point in time, I'm not looking to buy Nuix at all. They were a pretty good growth company until they listed on the ASX. And ever since they've listed on the ASX, this company has been experiencing significant problems. That's all I have for this technical update video, looking at CSL and 5 other companies on the ASX, ranging the quality of these companies ranging from the very best on the ASX, CSL, technologyone, to one of the worst quality companies. Actually, that's being a little bit unfair to Nuix. There are some way worse quality companies on the ASX, some mining exploring companies who will never have a dime of revenue in their lives. Those are the worst quality companies on the ASX. At least Nuix has some revenue. At least Nuix has been profitable in the past. And there is a chance that the management of Nuix could turn around the company. And if it does turn around, Nuix could be looking cheap right now. But that's a big if, in my opinion. If you have any thoughts, any opinions on any company I have featured in today's video, just leave your thoughts, your opinions, your comments in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified. And as I itch my side, have a great night and see you later.